let's go ahead and turn this over to Mel and Jay and get started.
Well, thank you, Amy, and welcome everyone. It's been a bit interesting week, and I think we have some interesting times to come. Let's take here our lovely pictures. Talk a little bit. Here's what we're going to try and get us to. These are the learning objectives to keep the CPE gods happy. But there are a number of tax proposals that were passed through the Ways and Means Committee this week, and I think it is important. Although Jay is going to go into some questions about how these, what could happen, whether some changes are possible, what those changes might be. But this is what's on the table right now. This is what we have to deal with. And I think there is a strong possibility that even if we see changes before the final version of this actually works its way through, a lot of the items we're going to talk about, a few numbers may change, but I think the thrust is likely to continue to be there. And so I think it is worthwhile to spend some time there. How did we get here? We got here because a lot of campaign promises were made back last year. Not all of those promises have made their way through the whole process, but many of them are still here. Things were cut down a little bit when President Biden released his budget proposals, but the reaction to that was difficult. And the infrastructure piece, originally, remember, it was intended that there would be one giant Build Back America Better bill. Now we see a separate infrastructure legislation, which was developed on a bipartisan basis in the Senate, has passed the Senate, is pending a vote in the House of Representatives. We're going to see how that plays out. There are some interesting rumors with regard to that. We will get to those in a minute. But with infrastructure having been pulled out, the remainder of Build Back Better, including most of the tax provisions, fell from the unified bill into the reconciliation process. And this is the process that allows the Democrats to get legislation through the Senate with only limited ability of the Republicans to slow down, but cannot, as long as the Democrats stay entirely together, cannot stop, at least in the Senate. And so that's where we're seeing the more controversial provisions. That's where we're seeing that's where we are going to see the tax provisions by and large. Final step was this week, end of last week, this week, when the Ways and Means Committee went into markup, went into session, into public session, and wrote the provisions that fulfill the budget reconciliations that they were given. Now, budget reconciliation instructions were given to all of the committees. We're going to focus today just on what is coming out of the Ways and Means Committee. And actually, we're just going to focus primarily on the tax increases that are included as pay-fors in this legislation. So what's on the, what's on the table? Well, let's start with what is actually one of the largest revenue raisers, and that is the change in corporate rates. We had been at a flat corporate rate of 21%. This moves us up to essentially 26.5% top rate, but goes back to the old system of having having graduated rates. So for corporations with low taxable income, we're looking at an 18% rate. Up to $5 million is the 21% rate we see there now. And then once we go above $5 million, the rate's going to be 26.5%. Now, if you go above $10 million, then there is a provision here that would require recapture of the benefit of the 18% and 21% brackets. That occurs at a 3% rate. So if you fall into that recapture group, you're really talking about a 29.5% corporate rate, marginal corporate rate. And that will essentially creates a separate bracket between 10 million and 19.567 million, which is the amount at a 3% rate that is necessary to recover the benefits of the 18% and the 21% rate. Now, notice that this is proposed to be effective for taxable years beginning after 12/31/21. So if you're on a calendar year basis, it's 21% this year, it's this table next year. If you are on a fiscal year basis, and your fiscal year includes 12/31/21, then you're going to be looking at a blended rate for that fiscal year, 21% for those months that precede 12, that lead up to 12/31, and whatever comes from this table with regard to the remaining years, using the averaging those two numbers to come up with your actual tax liability. This is one where we could still see, I think, some movement in the numbers themselves, but there is going to be a strong, and I think, frankly, it's going to be difficult to move entirely away from an increase in the corporate rates. For those of you that utilize the dividends received deduction, those will be increased in order to fit the 26.5% rate, as opposed to the numbers that we currently have, which are designed to work around the 21% rate. But of course, it's not just corporate rates that are in question here. Individual rates are proposed to go up as well. And primarily what we're going to see is the imposition of a return to the 39.6% highest marginal rate. Now, there are going to be a few blips with regard to how we get there, and a couple of slots where there is an increase in the rate applicable to a particular bracket. But by and large, it's going to stay with the current, at least for married filing joint, we're going to stay with the current rates through $400,000 of taxable income, and then move at $400,000 to a 35% rate, and at $450,000 move to a 39.6% rate. For singles, essentially the same type of development occurs, except now the breakpoint comes not at $400,000, but at $200,000 of taxable income, taking the rate to 35% between $200,000 and $400,000, and then going to a flat 39.6% above that. Unlike the corporate tax rates, there is no recapture of the earlier amounts or of the earlier benefits, but there is also, separate and apart from the taxation of taxable income, there's going to be a 3% surcharge that will be levied against modified adjusted gross income in excess of $5 million. Now, what's modified adjusted gross income? You know, every time Congress uses the term modified adjusted gross income, it seems like they have a different definition that's applicable to this particular section. In this case, modified adjusted gross income is adjusted gross income less investment interest that is being claimed as an itemized deduction. If you have investment interest that is actually creating a deduction on what used to be Schedule A, then that will be a reduction here in determining whether or not that particular taxpayer is going to be subject to the 3% surcharge. And that applies both to, well, that applies to all taxpayers at the $5 million rate, other than estates and trusts, which as usual have significantly sharper graduated rates, as well as a earlier trigger with regard to the modified adjusted gross income. Now, okay, what does this really mean? Well, let's take a look at what a single or married filing joint taxpayer would pay given certain amounts of taxable income. And as we see here, certainly the taxpayers that have $50,000 or $100,000 of taxable income, this is a non-event for. They're going to pay the same thing in the future in 2022. These are all going to be effective for 2022. Than they do if there's no change. These numbers, by the way, we have taken from a Bloomberg study that is estimating what the numbers will be for 2022. So we may not be hitting the exact dollar number, but I think it gives us a good sense of where things are likely to be. At $250,000, married filing joint, still not seeing any difference. Singles begin to, but really, in many ways, a fairly small difference. And as we go through, even up to $1 million, the increase, the percentage increase in income tax is not that substantial. It's real, it's there, but it is not necessarily that substantial. But this is simply how the calculations seem to be working out. Now, there are other provisions in this legislation that are going to affect capital gains, are going to affect capital income. They are going to affect ordinary income. And in some ways, they may even be more of an issue than this increase to 39.6%. At the top rate that is very popular to talk about on the news, but is not necessarily the most important item that we're going to see. Capital gains. Now, this is also needs to be taken into account as we move forward. Current rate is 20%. Top rate is 20%. That moves to 25%. There's not going to be a change in the definition of when you go to the top capital gains rate, but that rate is now going to be 25% and not 20%. The proposal that is coming out, the legislation that is coming out of the Ways and Means Committee would make this effective for gains recognized after September 13th, last Tuesday. And their concern here was they didn't want to put forward an effective date that was going to create significant market movement and was going to cause, I think, a race to take advantage of the capital gains rate before it went up. Now, that is this effective date is getting a lot of comment. I think Jay is going to go into how some of that may be playing out on Capitol Hill. And it may well be that date could change, but certainly no guarantee. And if it changes, it's not clear what it would change to. Maybe a future event that occurs, maybe around the 22nd. We may be seeing something out of the Rules Committee with regard to this. That might be an opportunity. The legislation is going back to the Senate. That might be an opportunity for an additional date. I would not necessarily count on, well, first of all, I don't think we can count on the date moving. We can't really count on this legislation ultimately being enacted. But we can't count on the date moving. if it moves, I certainly would not count on it going all the way to the end of the year. Everybody's going to have to kind of analyze and take their chances with respect to this. Now, there is a binding contract exception. If the transaction is subject to a binding contract on or before September 13, 2021, and the transaction is completed and the gain is recognized sometime this year, before 2022, then you qualify for the old top rate of 20%. You are not subject to the new rate of 25%. So if you have not closed yet, but are expecting to close, this is something that I would certainly urge you to go back and take a look and see what's evidence and what status you have. A number of the changes, and there's a polling question that just popped up. So everybody wake up, and it's morning, and click on so we make sure that we get that good CPE. I'm going to close this so I can see what I'm doing. Excuse me. On the pass-throughs, take a pretty good whack in this legislation. The pass-through deduction, the pass-through deduction is left in place. This is the 199 cap A deduction on the so-called qualified income. The deduction is limited. Now, the limit's pretty good. $500,000 on a married filing joint return, $400,000 on a single. Without any regard to individual AGI, there's no elimination. Now, keep in mind, that's the deduction. So you're talking about being able to cover $2.5 million if you're married filing jointly, $2 million if you're filing single. Also, those of us accountants who are here, this does not change any of the rules for specified service businesses. So if you have a pass-through specified service business, you still have the same restrictions, the same limits that apply under present law. And again, once you're about in the $500,000 range, you don't get anything. That one did not change. In addition, and perhaps more concerning, is if you are within a phase-out range, and here we're going to be talking about modified adjusted gross income again, between 500,000 and 600,000. If you're married filing joint, between 400,000 and 500,000, they're going to phase out your protection from the 3.8% net investment income tax that is currently available for active participants in a pass-through business. And that is actually a pretty quick phase out. And really what you're talking about is an additional 22.8 or 19% rate during that limited phase out range. And of course, there's just no deduction above that. But it is a very quick phase out. And once you get in the range, the benefit of being able to exclude that from the 3.8% tax is going to go away fairly quickly. Keep in mind, the net investment income tax for active participants under present law does not just shelter a portion of current earnings. It also shelters the gain that it can be recognized when the pass-through interest is sold. And that protection also goes away if you go past the phase out range of any of these. All right, we talked about modified AGI again, and once again, Congress is using a different modified AGI definition. Here we have AGI, but can be reduced by one, wages that are subject to FICA, can reduced by any net operating losses, and also to the extent that you're in an S corporation and there is PTI being distributed from prior years, that also may be eligible to be excluded from the AGI. Estate and gifts, big changes in the way. We are currently have a $10 million unified credit. This proposal would say, nope, we're going back to the earlier $5 million credit. Fortunately, we're not going back to the pre-86 number, which was significantly lower. But we're going back to the proposal is to go back to the $5 million unified credit for estates of decedents dying and gifts made after December 31, 21. We do not, well, we won't go into any of the planning that might go around that, except to say that particular care needs to be used with regard to the very common use of grantor trusts in estate planning, because here we have some significant changes. Again, to be effective here now for trusts created or contributions made into a grantor trust on or after, not the date of introduction, which is how we got the September 13, but the date of enactment, which is the date when the president actually signs the legislation, assuming that it gets that far. Grantor trusts have to be included in the taxable estate. If the grantor is deemed to be the owner of the trust at death, the grantor trust is going in. If the transfers are made out of the trust while it is a grantor trust, the trusts are treated, those transfers are treated as gifts. And if the grantor ceases to be an owner of any portion, so that 1 and 2 don't apply, that portion will be treated as a gift at that point. So in that case, you don't have to wait until the donor passes away, the grantor passes away. It could be subject to the estate and gift tax as early as when the grantor or the ownership by the grantor ceases to exist. Furthermore, if you have a sale between the grantor trust and the grantor, those will be treated as sales between the grantor owner and a third party. So gain may need to be recognized in that case. All of the rules that would normally apply to a transfer will apply there. Now, note over here on the right-hand column, in order to try and at least somewhat limit the effect of this for farming, for small business, the special valuation limits, which right now are not that high, are going to be increased to 11.7 million. Now, this requires you to essentially pass the business interest or the farm to a qualified heir. They need to continue to operate the business or the farm for a specified period of time. And the special valuation is just limited to the real property that is used in that trade or business. For farming, that frequently is one of the most significant items. In trades or other trades or business, that may be less. But in any case, special valuation available is significantly increased, and we see the number there. As I mentioned before, the changes in the grantor trust rule are going to propose to be made trust created or contributions made on or after the date of enactment. So do not rush out and create a trust today on the assumption that you can fund it next year, or a grantor trust today, so that you can, on the assumption you're going to be able to fund it next year, because that is not going to work, assuming that this legislation ultimately does go through. While we're at it, while we're dealing with savings, and particular the use of the savings in estate planning, there are a number of changes with regard to IRAs, particularly very large IRAs. So if your combination of your IRAs and defined contribution retirement accounts exceeds $10 million at the end of the prior year, and you meet a taxable income barrier, you may not continue to contribute, or you may not make the current IRA contribution. Now, that doesn't mean no rollovers. That does not mean you can't inherit an IRA from somewhere and have an inherited IRA, but you cannot make that annual contribution, which normally you're not going to be allowed with taxable income numbers that look that big anyway. 100%. And this really is, I think, the one that you need to focus on. If you are lucky enough, or if you have a client who is lucky enough to have more than $20 million in their IRA, and then to the extent those are in a Roth plan, out they come. If that still doesn't get you down to 10 million, then it needs to come out of the taxable plans. That gets us down to 10 million. If we get down to 10 million, 50% of the excess over 10 million now must be distributed. You can choose where it comes from. This is going to be effective beginning next year. So we're going to be looking, and what we look at is the balances in the accounts at the end of the prior year. They are really looking to cut back on the use of IRAs that have big figures with them. The concept behind the IRA, at least in the group in Congress that is pushing this legislation through, is that it was a small saver rule, and that its use with these kinds of numbers is just in excess. There are also some additional IRA rules. If you're really, and these involve what you can put in your IRA. If you've got, essentially, if you've got to satisfy the blue sky rules, you got to prove that you've got education, that you've got enough assets, that you have a license to do something. You cannot put those securities in your IRA. If you have if the owner of the IRA has a 10% direct or indirect interest in a business, and that business, those securities are not tradable on an established securities market, they cannot be in the IRA. Generally, these rules are going to be effective at the end of this year, proposed to be effective at the end of this year. If you've already got the securities in your IRA, you have a 10-year period a 2-year period in which to dispose of them. But the date of enactment is going to be a trigger here. If you don't get the 2-year transitional period for anything added between the date of enactment and 12/31/21. So keep all that in mind. Really, this, I think, does affect. They are also looking for situations where there is too much contact, there is too much business relationship between the IRA and the owner, or the stocks in the IRA, the securities in the IRA, and the operations of the business. And in that, so they're also going to be looking at treating the owner of the IRA as a limited person and apply the rules that normally prevent connection with those. The backdoor to the Roth IRA, they believe that, at least again, for people with sufficient incomes, you no longer are going to be able to come into the back door by taking your after-tax contributions to qualified plans or a regular IRA and then converting them into Roth status. There are a couple of items that I want to just quickly mention here with respect to corporate reorganizations. You can see we will try and go, we are anticipating part 2 of this session coming next Friday. We will go into more detail with regard to these next Friday. But essentially, these deal with divisive reorgs and the distribution of securities in excess of basis and assets that would not get around that would not get around the non-tax rules effective there. And again, this is one of these things that is viewed as sort of a loophole closer. And so they're looking at making this effective for transactions after the date of enactment. And Amy, I have somehow frozen.
Okay.
Can you take control back and move us to the next slide?
Yes. Try clicking for me.
Okie doke. Very good. Losses 163G, excuse me. Traditionally, losses were treated as occurring, worthlessness was treated as occurring at the end of the year. The provision would change this to treat it as the, quote, time of the identifiable event establishing worthlessness, and also clarifies that those have to be treated as taxable losses. Some other provisions, business interest, 163J limitation on the deduction of business interest for business interest that is, current law would provide a unlimited carryover of these amounts. For tax years beginning after 12/31/21, it's going to be changed to a 5-year limit. Now, I think it's worth noting that we're sort of taking the first and the last item here. The 5-year limit is going to apply to the total amount of disallowed interest in tax years beginning after 12/31/21, determined on a FIFO basis. Well, the way 163J is written, and I do not see a change in that, this would allow you to take your pre-21 losses that carry into a post-20 or pre-21 disallowed interest that carries into a post-21 year. Use that first in the post-21 year, which should, in some cases, at least unless you are in a permanent 163J creation situation, should ameliorate this change over to the 5-year limit. Digital assets, we saw some additional disclosure with regard to cryptocurrencies and other digital assets included in the infrastructure legislation. This takes a more concrete step and says that the wash sale and constructive sales rules are to be extended to digital assets. And for those of you who are involved with 1202, the small business, small corporate businesses that are allowed to essentially avoid, depending on how you do it, up to 100% of any gain on sale. A lot of hoops you have to jump through, but 0% is a nice tax rate. For again, taxpayers with AGI, and this side, there's no modification I found here. So let's just say plain AGI of 400 grand or more, they're going to be limited to 50%, even if under present law, they could access either the 75% or 100% accelerated rates. Few items, actually the amount that is spent in tax, although not as great as the amount that is raised. There are significant tax reductions, mostly in the family lower income areas, but also some ones that I think that will be more common to this audience. A lot of concern about the rule that floated in to the 2017 legislation that would require R&E to be R&E expenses to be amortized after 2021. That now has been pushed back, or would be pushed back in this legislation, to 2025. There are a number of green energy credits and incentives that can be taken advantage of. Hopefully, we will get into more details of that in our second half next week. A lot of additional abilities to issue. I don't want to just say private purpose bonds, but that I think is really the direction that this is focusing on. A lot of this is going to be to facilitate the kind of investment that may be needed for infrastructure improvement. But there are obviously, as is always the case with the bond market, some fairly detailed rules that are really a little bit beyond the scope of this session. Also, the new market tax credit, with apparently without any real change, is going to be made permanent. So that is for those of you who have looked into that and found your way to take advantage of that, that is not something that's going to go away. You can keep that one in your portfolio. That is a summary of at least the highlights that are included primarily in the tax increase portion of the legislation. But this is not the final stop. This is not the final resting place of this legislation. And I'm going to now ask Jay to step in and talk about where we go from here. Jay?
Yep, thanks. Mel, can you advance the slide?
Oh, sure.
So like Mel told you, he gave you the highlights. I'm going to give you the lowlights because this bill is ugly. And it's one of the ugliest bills I've ever seen over 20 years on Capitol Hill. So let's start from earlier this week. The Ways and Means Committee conducted 4 days of markups. And by markups, what that means is they take the bill and they mark it up. This was not a markup. They did not mark up this bill. The bill that entered that committee was the bill that left that committee. And even though that happened, several Democrats on the committee actually complained about this bill for certain reasons. One actually voted against it. No Democrat offered any amendment to this bill, which is a signal that this is a leadership bill, which means that this isn't working with the people. It's not really going to be hammered out. This bill was done and it's not supposed to have many changes to it at all. Republicans actually offered 60 amendments. I think it was 66 exactly. They were more messaging amendments because they knew they weren't going to get adopted. So why try kind of thing. But it did last hours into the night for all days except the last one. And it pretty much didn't have to happen because the bill did not change at all. Now, the net effect of this bill is currently $900 billion of a tax increase. This number will likely change, and that will happen later on. And so here's what's going to happen moving forward with this reconciliation bill. The budget is going to basically, there are either 13, I think there are 13 committees that actually wrote legislation for this reconciliation bill. The budget committee is now going to bring all those pieces together and create one big bill. This bill is supposed to be $3.5 trillion. There's some unofficial estimates that are floating around that this bill is actually $4.7 trillion. They can't use that number in this bill. They have to cut this down to 3.5 to fit into the reconciliation bill. And so now these are unofficial estimates, but they are from Democratic and Republican sources. And so there is a question as to how much time Rules is going to have to take to actually get this bill down to size. And so the thought is that, oh, they're going to vote on this next week. Well, if they have to whittle it down, that might not be what everybody does. And so there's going to be a question to that. But one thing, besides all the whittling, nothing's supposed to be added to this bill in the budget committee. So once the budget committee gets its act together, whittles it down, and passes it, which they're expected to do, it goes to the rules committee. And the rules committee is the committee that sets the rules for how a bill is debated on the floor. Now, normally the rules committee would rubber stamp a bill that passed a committee and say, yes, here it is, it'll go to the floor tomorrow, we'll have an hour debate and no amendments on it, and that's it, and it's done. This markup for the rules could actually change this bill. The big one is the state and local cap that people want repealed, and that other people don't want repealed, and that is the Democratic Party I'm talking about. And so there could be a partial repeal. According to the staffers, 1 year of this deduction to repeal 1 year of the cap is $90 billion. So there's 4 years left to this cap. And so you're looking at, what is that, $360 billion. So you would, if they did a full repeal for 22 through 25, you would have to cough up $360 billion. And some are arguing that enhanced reporting for banks where certain transactions $600 or over would have to be reported to the IRS might be what they use to offset the SALT cap deduction removal. And so we're going to have to see about that. One thing that some Democrats are calling for is to repeal step up. And it's being argued as a wealth tax when it's not really a wealth tax, but that's how they're being argued. But on the other side, there's a really strong push to not have this in the bill at all, on the other side of the Democratic Party, I mean. And so what's going to happen now is that the House Majority Leader, Steny Hoyer, about an hour ago, just announced that they're going to have a vote on the infrastructure bill on September 27th. It's a dear colleague letter. The letter says they will consider this reconciliation bill during that work period. So Steny Hoyer gave a specific date for a vote on the infrastructure bill. And once that infrastructure bill passes the House, it can go to Biden to be signed into law. And it's done. The reconciliation bill, after it passes the House, it has to go to the Senate and get debated. So there is a rumor that a Rose Garden ceremony will happen for the infrastructure bill on September 28th. So there's no way that this, I'm sorry, did I say, the infrastructure bill will be signed into law on September 28th. There's no way that the reconciliation bill can make it through both chambers in that amount of time. And so the question becomes, what's going on with the reconciliation bill? Okay, so these are the words that are being used in Washington. They're not meant to discredit anybody, but there are progressive Democrats, which are very liberal, and moderate Democrats, which are less so liberal. These are the only two groups that are going to vote for this reconciliation bill. No Republican is going to vote for this bill in either chamber. And so just to make it very clear, the progressives like the reconciliation bill because it provides childcare. It provides the SALT infrastructure. They don't like the infrastructure bill because of what it doesn't do, which is not provide childcare and SALT infrastructure. The moderate Democrats like the infrastructure bill because it does infrastructure and it doesn't have tax increases. The moderate Democrats don't like the reconciliation bill because it has tax increases and they don't like that. So those two are going to go at each other. And if the House basically passes the infrastructure bill, like Steny Hoyer just said an hour ago, on September 27th, because progressive Democrats don't like that bill, and there's 95 of them, that means that Republicans in the House have to vote for the infrastructure bill to pass it. And I've been on emails throughout this thing. There's a whip count going on right now. The whip count means, okay, how many votes can you really get on the Republican side? And they think there's enough votes on the Republican side to not make up all 95 progressive, but to make up a good chunk of them, because this bill, this infrastructure bill, is already bipartisan when it left the Senate. In fact, the Minority Leader McConnell backed this bill. And so for House Republicans to vote for the infrastructure bill wouldn't be a big stretch. And so the progressives are now saying, hang on a second. Speaker Pelosi promised that we would vote on the reconciliation bill first, and then we would only support the infrastructure bill after the reconciliation bill passed. So the question becomes, is reconciliation going to happen before September 27th? Because that's the time that Hoyer said the infrastructure bill is going to pass. That gives the House and Senate 2 weeks to pass a $3.5 trillion bill that is currently $4.7 trillion that needs to be whittled down to $3.5 trillion. And meanwhile, keeping every moderate Democrat happy in both chambers. That's a really, really big ask. So some of the reporters that I spoke with are actually 5 seconds or 5 minutes ago. They don't think the September 27th vote on infrastructure will even happen. And so we're back into the mud. There is so much that can go wrong with this bill that it would take hours to explain. But basically, here are the top things. If progressives don't vote for the infrastructure bill, their argument could be it's because you didn't vote for the reconciliation bill first. The moderates, Democrats, may not vote for the reconciliation bill because they might be saying, we wanted the infrastructure bill to be voted first. And currently right now, who knows what's going to happen with that. The September 27th deadline could be missed because everybody's mad at everybody and they're not going to talk to each other. And so let's just push this off until something else happens, which would then stall the reconciliation bill, which would anger the progressives. Now, in that mix is a president that needs a win badly. And so he basically wants this infrastructure bill signed into law or passed the House, because literally all the infrastructure bill has to do is pass the House. That's it. And it goes to him. He can sign it and then he can have a win. And currently he's at 45% rate of approval, which at this point it's the lowest for presidents at this time in the presidency. So he's looking for a win. So that also pushes off the whole idea of what's this reconciliation bill going to do. And the Senate is a whole nother story, but we can go into that later. But one add I'm gonna put in here is that there's a thing called the debt limit, and this is currently not attached to the reconciliation bill. It's going to be attached to what's called the spending bill. They're going to try to basically extend federal spending beyond September 30th using this thing called a continuing resolution. It's called a CR. The debt ceiling is supposed to be in that bill. That bill has to pass the Congress, pass the House, and then go to the Senate, where Senator McConnell has said, if the debt ceiling increase is in that bill, I will do a point of order, and it takes 60 votes to get that point of order removed, and you're not going to get 60 votes, so it stalls. So what could happen is there could be a federal government shutdown on September 30th, and the debt ceiling won't be addressed, which they have about maybe mid-October, late October to actually deal with that. But one way to make this go through would be tie it to the reconciliation bill, because it's structured in a way that only Democrats need to support it. That's it. Now, the scuttlebutt, oh, we have a question here, guys, so wake up and check the question. The scuttlebutt on Capitol Hill is, why aren't Democrats attaching this to the reconciliation bill? And there's two reasons. First one is that the budget process has to start all over again. And that's weeks, if not months, of trying to get this bill through. And that would also mean that the infrastructure bill would be stalled, which Biden wants to sign into law. So there's a question on a lot of people's minds of what's the status of this reconciliation bill when they're not, it's just, why would you use this for the debt ceiling? It's the easiest thing to do and you're not doing it. And they obviously know it. But anyway, one thing is that because of all these things going on, it's really important to actually pay attention to what's going on, and we will get out as much as we can. The other thing is that this bill, if it is 3.5 or whenever it gets to be 3.5, it's only going to get smaller in the Senate. There's no expectation that this bill's price tag is going to get bigger in the Senate. It could get much smaller. But the other thing too is these pieces that are in the bill are likely going to be the pieces that survive if this bill passes. So there might be cuts in things, but these provisions might be the things that we see in the final product. It just remains to be seen. And there's a whole statement on Capitol Hill that a bill is always considered dead until it passes. This bill is very much considered dead, and so it just might pass because you just never know. So, and that's all I've got.
Well, thank you, Jay. And that is that is indeed the slogan. I mean, we saw I think every major tax bill for the last 30 years, maybe now close to 40 years, thinking back to the almost back to the 81 Act, was at some point declared dead. And surprisingly, a number of them did find their way through. So we're going to keep on top of this. We're going to keep track of it, and we certainly hope that everyone will be joining us come next week. Why don't we? Let's see here. If I can go on. Let's deal. Well, I take that back. We do have a number of questions, and Jay and I will try and answer them. I'm going to pull up the questions here. And let's see what we have. Oh, okay. Well, let's start from the bottom because this is a very good one. Is raising the preferential tax rate on qualified dividend income off the table? No. And in fact, because there is treating, what is off the table seems to be treating qualified dividends as something other than long-term capital gains. So the increase from 20 to 25% top rate applies to both long-term capital gains, net long-term capital gains, and qualified dividends. Qualified dividends are not going to go back. There's no indication that anyone is looking to take that back to no indication that anyone is thinking about taking that back to an ordinary income status, but it will be subject to the same increase from 20 to 25% as capital gains. Schedule A state tax limits. Any thoughts, updates if the Schedule A state tax limitation will be repealed, which would moot state efforts such as California that have started workarounds for pass-through entities?
We don't know, but it could be scaled back. The thought is that it might be under 400 can grab it with no limit. Over 400 cannot grab it. That's the scuttlebutt. But right now, we don't know, but they might have to do something because there's a lot of guys, a lot of Democrats that want to vote, that will only vote on this bill if SALT is addressed somehow.
And I think that is, and I know that there are a number of the state provisions that sort of automatically disappear if the Schedule A state tax limit is removed. How you would interpret that if what happens is you remove the limit for everyone under $400,000. I think that's going to have to be an answer that we can pose to our state tax people, but is a little bit beyond the scope of those of us in the ivory tower of Washington to fully fill you in on. A question here is, what is meant by the date of enactment? Yes, it is when the president signs it into law, which is why people do need to keep a focus on that. confirm the maximum capital gains rate is only proposed to go to 25%. The idea of taking it all the way to the top income tax rate of 39.6% is not on the table, and I don't believe there's any indication that it would go back on the table. I don't know. Have you heard anything to that extent related to that?
I have not. No.
Okay. A few other things. The $5 million threshold for the 3% surcharge. Yes, it is the same for married filing joint and for singles. The only difference is it would go down from 5 million to 2.5 million if you have married filing separately, under the basic rule that if you're married filing separately, it's half of whatever married filing joint is. I am not aware of any tweaks to bonus depreciation or Section 179, or really depreciation in general in this, other than some maybe some expensing that we're going to see as a incentive on the green energy front. As I said, we were going to try and get a little deeper into that when we meet again next week. The PSCs, the rule with regard to PSCs does not change. So whatever your PSC, Personal Service Corporation rule is now, to the extent it is tied to the individual rates and not to the corporate rates, it is going to continue to tie to the individual rates, and will then pick up whatever changes are made to the individual rates themselves. I think we're down to 1 minute left to go. Amy, do you have a last thought for us?
Once again, we do have part 2 of this legislation coming up on the 24th. You can register on our website, and if you're Eide Bailly staff, you can register in the Learning Center. We will have this recording available for everyone and sent out probably early next week, so watch for that to come as well. And we do thank you all so much for attending. Thank you, Mel. Thank you, Jay. And we will talk to you guys next time.
Yeah, thank you. And thank you all for being with us. And
Yeah,
we very much,
it.
Jay and I very much look forward to talking with you again next Friday. And as always, if there was a question you had that you didn't get an opportunity to put in, or that we did not answer, feel free to shoot an email to both of us. It's first initial and last name at idebailly.com. And that is probably the most reliable way to reach either of us.
Awesome. Thank you guys. Have a great weekend.
Take care, everyone.
Bye.